Nobody is talking about the $1.25 trillion reason Fed just reversed course. $1.25 trillion. That's how much credit card debt Americans are currently carrying. And in 2 weeks, on July 28th, the Federal Reserve could do the opposite of what almost every investor expected just months ago. By the end of this video, you'll understand exactly why relief on the debt isn't coming anytime soon and might actually get worse. Section 1. The reversal nobody expected. Just months ago, Wall Street was pricing in multiple rate cuts for 2026. Fed had already cut rates 3 times in the second half of 2025, bringing the benchmark federal funds rate down from a peak of 4.5% to a range of 3.5% to 3.75%. Then everything changed. Kevin Warsh took over as Fed Chair in early 2026, and his first meeting on June 17 marked what analysts are calling a dramatic shift. The Federal Open Market Committee voted unanimously to hold rates steady, but it had removed the forward guidance language that has signaled a bias towards future cuts. The committee is closely watching dot plot, which shows where each policymaker expects rates to go. It raised its earlier projection for a cut this year entirely and pushed any reductions out into 2027 and 2028. 9 of 19 officials now say a hike, not a cut, is the more likely next move. The median projection among the officials now points to the federal funds rate near 3.8% by year-end, roughly 16 basis points above where rates sits today. Goldman Sachs, one of Wall Street's most followed research desks, responded by pushing its forecast for the next rate cut all the way out to 2027. That's a reversal in one sentence. The market expected easing and instead got an explicitly hawkish Fed signaling the next move could go the other way. Section 2. Why the Fed flipped. Fed Governor Christopher Waller put it plainly. The central bank's focus has, in his words, completely flipped from the labor market concerns to inflation containment. The numbers explain why the consumer price index hit 330.3 in March 2026, a 1.1% jump from the prior months alone, and the 12th consecutive monthly increase. Fed's own inflation projection for 2026 was revised upward from 2.7% to 3.6%, nearly double the 2% target, a target Waller has explicitly said the Fed is not willing to move. Much of that pressure traces directly back to tariff policy. Layered import duties on goods from dozens of countries, the kind we have covered before on this channel, have been pushing prices up across nearly every category, from groceries to prescription drugs to raw materials manufacturers rely on. The Fed doesn't set tariff policy, but is the institution left to respond to the inflation tariffs create, and its answer right now is to keep rates higher for longer rather than risk cutting into a still rising price. The Fed's July 28th and 29th meeting is where markets will find out whether higher for longer becomes higher, period. Section 3. What this actually cost you. Borrow. Here's where the Fed's benchmark rate turns into numbers on your state. The average annual percentage rate on credit card accounts carrying a balance stood at 21.5% in the first quarter of 2026. Now, card offers are worse, averaging 23.8%, with some issuers advertising rates as high as 27.4%. Mortgage rates are sitting near 7%, a level that has reduced home affordability compared to the pandemic-era lows and reinforced what economists call the lock-in, with homeowners with older, cheaper mortgages refusing to sell and take a new loan at today's rate, which keeps housing inventory tight and prices elevated for everyone else. Auto loans aren't spared either. With 5-year new car loan rates near 7%, the average monthly car payment climbed to $773 in the first quarter of 2026, an all-time high. Buyers are stretching loan terms longer just to make the payments work, which adds to the total cost of the vehicle over time. Every one of these numbers moves in the same direction Fed's benchmark rate does, and right now that direction is not down. Section 4. Who's already feeling it? Americans carried $1.252 trillion in credit card debt in the first quarter of 2026, down slightly from the record $1.277 trillion set the quarter before, but up 5.9% for a year earlier. The pain isn't distributed evenly. Researchers at the New York Fed describe what they call a K-shaped pattern. Higher income households are generally keeping up with the payment, while lower income households are falling further behind. A survey of 2,000 consumers found that 53% carry credit card balances specifically to cover essential expenses like groceries and utilities, not discretionary spending. And 35% of consumers earning under $50,000 reported their financial situation getting worse over the past year, compared to 27% those earning more. Meanwhile, the personal saving rates fell to 4% in the first quarter of 2026, down from 6.2% just 2 years earlier. Americans are saving less at the exact moment borrowing is getting more expensive, not less. Delinquencies tell tell a similar story. Student loan payments 90 or more days late reached 9.6%, and overall late payment delinquency across household debt climbed to 4.8%. Consumer sentiment, as measured by the University of Michigan's index, fell to 53.3 in March 2026, a level survey itself classifies as deep inside recession territory, even though the unemployment rate held steady at 4%. The gap between how people feel about the economy and what the job numbers actually show is itself telling. Households are reacting to the monthly math of rent, groceries, and minimum payments, not to whether their job feels secure. Section 5. What $1.25 trillion mean going forward? Now here's where the number from the top of the video actually matters to your monthly budget. At the roughly 21% average rate reported in the Fed's own consumer credit data, typical $6,500 revolving credit card balance generates about $114 in interest every single month. Minimum payments on a balance that size barely touch the principal, which is exactly why so much American household debt stretches on for years without shrinking. If the Fed had followed through on the rate cuts markets expected as recently as this spring, the math would be improving throughout 2026. Instead, the Goldman Sachs now projecting no cut until 2027, and 9 of 19 Fed officials openly discussing a hike instead. That $114 a month isn't going anywhere. It could climb higher if the July 28th meeting confirms what the dot plot is already signaling. $1.25 trillion in credit card debt. Fed that just told markets relief isn't coming, and a decision landing in 2 weeks that will tell millions of households whether their minimum payment goes up or just stays exactly where it already hurts. $1.25 trillion in credit card debt. A brand new Fed chair who just told markets to stop taking cuts, and a meeting in 2 weeks that turned no relief into even high. Nobody is talking about how a policy decision made in a boardroom in Washington turns directly into an extra interest charge on millions of Americans' next statement. This isn't a story about whether the Fed is right to fight inflation. It's a story about what happens to your minimum payment while that fight continues, with no clear end date in sight, and with a recession-level consumer sentiment reading sitting right alongside a stable jobs number. A combination economists say rarely happens without one of them eventually giving way. Drop a comment and tell me whether you think the Fed hike holds or finally blink on July 29th.